to talk about, I'm calling it exam technique, but let me call it much broader than that. Let's call this study approach. So financial instruments, I can confirm right now that the majority of our APC candidates don't love the standard. And those that end up loving it, they love it so much. So it's like there's no middle ground for financial instruments. Like either you love it or you don't love it. But I want us to therefore move to I love financial instruments. I want you to get to a point where now you are sitting there and you look like a nerd and you are saying that I hope they bring financial instruments in this upcoming test. So that's the kind of a desire that I have for today, because I want you to see these things and understand how you really deal with the complexity here. So the first thing that I want you to do is to understand these things. And understanding these things means that when I say something, you know what it is. It starts there. I once saw an article where a non-CA was really criticizing CAs and says, I was surprised when I was sitting with a newly qualified CA and we were talking about options and they didn't have a clue what those things are. I was like, yeah, maybe clearly they didn't go to Indunamu. I don't know what happened, but I'll want to just make sure that everyone here, you are clear about what is what. If I say an option, I want you to know what it is and how it works. If I say derivative, if I say a financial asset, a financial liability, I want you to be able to know what that is and how that works. Okay. Then number two is to also say that if I say an option, can you really see it? Because a lot of you in your life, you have engaged with what? You have engaged with financial instrument. And the most common instrument you deal with, it is the cash and also the borrowings, either the one you are giving or the one you're receiving from the banks or friends and family. So you have, if you are here in this session, I believe you have either borrowed money from someone in your life, or you have borrowed someone or lent money to someone. So you have originated or have been a holder of a financial instrument if you're here, right? And as I'm saying, if you are saying that, sure, Renan, I don't know these things, I've been privileged, then at least then you'll have been privileged to have cash, which is also a financial instrument. But as I'm saying, you will have engaged with financial instruments at some point in your life. So do you understand what it is and how they work? Okay. Then we will need to understand the framework to report on financial instruments. There is a framework. What do I mean? There are a number of standards that deal with financial instruments. Do you understand why it is like that? Do you understand where you need to start? How you navigate within these standards? Then, what if you are busy navigating and you find you've got a financial liability? What if you are navigating and you find you've got financial assets? How do you now deal with it? And you might be required to integrate your knowledge to comprehend some complex instruments. And some of the principles that we have here, we are going to integrate them somewhere else for other things to make sense to us. And after you are there, so you will know that, as I'm saying, that so it's like this is consequential. Start here, then move down, and so on and so on. So the last one, I'm saying do millions of practice questions. individual ones, dealing with just financial assets only, dealing with financial liabilities only, and then dealing with integrated ones. So this is how I want you to think about financial instruments. So now let's be a little bit more practical, and I want you here to be on board. So let's be more practical here. So number one, let's imagine with me the following scenario so that we start understanding these things, right? One, you right now, you want a car because your audits are all over the show. You are tired of having to come back late using public transport system. Sometimes you are so late that the train closes and you have to use your own Uber and it's expensive and you're saying, no more, I want a car. But you don't have enough money to then go buy your car. Then what do? You start shopping around and looking for one that will sell you a car that you like on credit. You find a dealer. The dealer said, sure, we can give this to you for 150. Then you ask, what will be the installments? They say, no, at 150, we are looking at 4,500 per month. Oh, I can do that. What is the process? You have to complete this form and we lodge it with the banks. Then the banks the banks will give you their offers and you can choose any of our banks in order to do it. Any of the banks in order to fund the purchase of the car. So the transaction there is such that number one, you have what? So maybe let me open Excel so that when I'm talking through this, we are essentially on the same page. Because I want you to understand where we are coming from. And I believe if we're there, you will never, ever not like financial instruments. So there's you. You what? You want a car, a vehicle, let's be fancy. You want a vehicle on credit. You want a vehicle on credit. You then approach a dealer who connects you with what? With banks. Then the banks offer you a loan of 150,000. Terms and the interest rate based on what? On your credit profile is 12% per annum. And the installments are what? 4,000 per month. And the term is it's 72 months, 6 years. So the bank gives you this. And you so want the car and you also think this is a good deal, so you take it. So what happens when I take a loan? What does taking a loan mean? Taking a loan means that you are given a contract. So the bank then issues a contract. So issue is just saying what? It's just that it prepares. It prepares a contract with what? With your details. And it will tell you things like the interest rate. This is equals to the prime rate plus, let's say 2, without being too worried. Then they tell you that you see this little 2. It is because we realize that you're a first-year trainee. And we realize that your credit record it's a little bit questionable. And we are realizing that as a trainee, there's prospects that what you will be a CA soon. So otherwise, we'll have been giving you prime plus 4, but we have considered all these things and we've given you prime plus 2. So stay with me here because this is the example which we're going to be using in order to unpack everything. So now we are here. So obviously, when they give you the 2%, they have an assumption of what your ability to service this debt. So they are saying that after taking all this consideration, this first year trainee will be able to pay for this vehicle over the next, what's the word? The next 72 months. So then after they've done that, they gave you an offer, you then accepted the offer. They say, great. They prepare a contract with your detail. But preparing a contract, it is what? There are costs related to it. Then they tell you that we are going to charge you initiation fees. Initiation, how do you write this now? We are going to charge you initiation fees, but we are limited by the legislation. The legislation says we charge 5,000 plus VAT, so it's 5,700. So you are busy there listening. And then afterwards, they send the contract through the dealer. And they then do what? They then said, here is the contract. Then when you get the contract, you review it. And you sign the contract, or otherwise you accept the terms and conditions of that contract. And to make sure this contract does not change, you then hold on to it. So you then hold on to it. In other words, if I ask you if you bought this car last year, I ask you, what are the terms that you then agreed to? You can give me the terms because you've held onto this contract. So the bank issued it, and then they gave it to you. You signed it, accepted it, and now you are holding that contract. Flowing from that contract, it's then on day one, there's going to be what? There's going to be cash from the bank to you and directly to what? To the dealer. Then you will be offered an option to say, do you want to pay this 5,000 now, 5,700 now, or rather, should we just give you a loan of it? Then you could say, give me a loan. Or then the bank says, great. So the loan that I'm giving you, it's actually the 150 plus this initiation cost. So this is the true loan. This is the loan that we are giving to you. And we're going to take 150, pay it to the dealer. And we're going to take the other and pay it to what? To ourselves, because that is the cost of originating this transaction on your behalf. So your loan is 155, is just the money is being transferred to what? To different parties. So now it means that you will then be paying off the 4.5 plus the initiation cost. So now we therefore need to decide whether what? Ongoing. So let's say ongoing. So ongoing, you then service the debt on what? On a monthly basis. You then service the debt on a monthly basis. So now when we talk about servicing the debt, the moment you then agree that the bank needs to do what? Needs to then include what? Include these service charges, then the installment that they will have charged you will have taken that into consideration. So it will have taken that into consideration. So that means that somewhat the rate that you are then paying, you will then be paying what? You will then be paying installments to service the 155,700. So you will be paying that, but the benefit that you actually got, or how we got here, is that the benefit was 150,000 because that's the value of the car. So it's like for you to get a 150,000 car, you needed to take this debt and what? And service it. So your installments are servicing the entire 155, but the benefit that you actually got was 150. So what do I mean? So let's clarify that because that's a very important point. You wanted a car for 150, so that's the benefit that you are getting. But to get here, you needed to do what? You needed to then get a loan of 155, of which that loan was reduced, or not, the amount you got of 155 was then reduced by the transaction cost you paid, so that you are left with the 150 in order to pay the dealer. Does that make sense? So in other words, we are assuming you don't have any cent in your pocket, so you needed to take a 155 loan and then pay transaction costs from it, so that you are left with 150 in order to purchase the asset. So that is the thinking. So that is the thinking right here. Any questions so far? Are we understanding how this transaction is working? Are we all good? So we're gonna now overlay the what? The reporting, because you now have a piece of paper that you need to account for in your books, and so does who? And so does the bank. So the both of you have got a same piece of paper that you want to be able to report to. From your side, let's just understand. From your side, you got a benefit from day one. So that needs to go into your books that when I woke up, I had what? I had zero in my account. Yes, when I slept, I had zero still, but now I had acquired an asset and I now owe the bank. Okay, so now that's how your day has been. You now have an asset and you now owe the bank. The asset, we are not worried about it because we can clearly see it. So that transaction is separate. But it is now this contract that you now have with the bank. And what do we do? You now have with the bank, and you then have what? You then have an obligation to pay the bank. Then on the other side, the bank, when they started, they had nothing on their SFP. But at the end of the day, they are closing with this contract that they signed with you, which is giving them a promise to receive cash in the future. So that is our starting point. We are now having this contract. So we are understanding it. Now it's a matter of how do we then bring it together? So do you and the bank use the same principles to account for this contract, because it's exactly the same contract. We are now saying, do you account for it in the same manner? Then the standard now comes in. So let's understand the framework. The standard says that we have to first give names for what you guys have done. What is it? So the piece of paper that you have and the piece of paper that the bank has, do we call it the same thing? Given that it's the same piece of paper. That's the first question you need to ask yourself. Do we call that piece of paper the same thing? Before we talk about the accounting, we have to ask, do we call it the same thing? Oh, but it is the same paper. Why will we not call it the same thing? Because I'm thinking that if it's a vehicle that the dealer had and I bought it, it is still a vehicle, so we should call it a vehicle still. Why is this question now relevant? Because if it's a piece of paper, it is a piece of paper. There should not be any difference. Okay, but that's question number one. That question is answered by IS 32. So that's how the standards work. That question that we've just asked, what is it that we have? It's answered by IS 32. So therefore, you need to always start with IS 32. Because IS 32 will give it a name and say, you see this piece of paper, it is a financial asset, it is a financial liability, it is an equity instrument. That is why I say you start there. Number two, after determining what you have, you then have to see where and how do I put it in my books, and what do I do with it going forward? So we are talking about the accounting implications. So now we then get the financial implications or the accounting implication in IFRS 9. So we don't just go straight to IFRS 9. We have to go around, start with IS 32 and then go to IFRS 9. Okay? I am there in IFRS 9, and this is a long standard. So where do I start? You then need to identify, which is something that IS 32 will then help you to clear. Who are you in this contract? And what do you have? So you've already decided that I have a financial asset. I have a financial liability. So if you then have either of those, you are in IFRS 9. Then IFRS 9 will say, if you have a financial asset, you now apply these provisions from here to there. And if you have a financial liability, start from here and finish there. So this standard deals with both financial assets and financial liability. But to know which section of the standard you are in, you need to do what? You need to know what you have from IS 32. But now I had mentioned in my IS 32 discussion that it could be one of three things: financial asset, financial liabilities, and equity instruments. So we are saying we know where we need to go when we've got a financial asset and financial liability. But what if I've got an equity instrument? Then you stay in IS 32, and it will tell you what to do about that equity component or equity instrument. Okay, so IS 32 is my primary starting point. Then I've got IFRS 9 or otherwise I'm still in IAS 32. Then now I've done the accounting. I want to tell my people about it. I want to tell my friends and family about what this means, because you know how life is. So let's assume that you need to tell your friends and your family about this debt, just in case something happens and you might need their help. So they need to understand the risks that you are facing by having entered into this piece of paper agreement. You need to also show them how this will affect your cash flow going forward. Maybe you used to buy flowers for them. You need to say, no, I'm not going to buy flowers because you can clearly see for the next 12 months, I'm committed to this and so on. So you need to then help the people that are interested, your stakeholders, and most importantly, your investors that are interested about these financial instruments you have entered into. Because they don't see your journal entries, they see only the end picture. And that's where IFRS 7 comes in. So IFRS 7 is a disclosure standard. It says you have decided, you have accounted, but tell your investors about this instrument. Tell the users of your financial instrument about this instrument. So that's where IFRS 7 comes in. You will never touch IFRS 7 if you have not gone through IAS 32 and IAS what? And IFRS 9. So that is the framework that we then have with regards to what? With regards to financial instruments. Are we clear about how the standards work before we jump into IAS 32? Okay. Cool. So we are here. So the contract, let's all understand it, because we're going to unpack it even more. So let me have my standard with me so that when we talk, we are all aligned. So I've got my A2 with me, still old. The older version, I need to invest in the new one. But you don't need the new one for our discussion today. You will be fine, even if you got, I think, from 2020, just like me. Okay. So go with me to IAS 32. Because now we need to know what we have, right? We need to know what we have. So I then go to IAS 32 and I say, what am I doing here, Rendani? Then the objective clarifies for us. We are here to establish principles for presenting financial instruments as liabilities or equity, and for offsetting financial assets against financial liabilities. All right. It applies for principles of presenting financial instruments as liabilities or equity. Then what was all that discussion about assets that Brendan was talking about? Because this standard seemingly is clear about what? Presentation of financial instruments as liabilities or equity instruments. Then let's read further. It applies to the classification of financial instrument from the perspective of the issuer. The perspective of the issuer, highlight that in a prominent color. From the perspective of the issuer. What is the issuer? Between you and the bank, who is the issuer? The issuer is the person who receives the money. Is the person that approached someone to generate the piece of paper. So it's not necessarily the person who generated it, it's the person who approached someone to generate the piece of paper. So what are you in this contract? Are you the holder or are you the issuer in this contract we've mentioned? Who approached who?
I approached the bank, so ideally I would be the issuer.
100%. So the bank, it's like they are not going to use the standard to get some of the answers. You are the one who's going to give the bank the answers when you read and go through the standard. So this standard, then, it's so important that we understand why it is now from the perspective of the issuer. Because now, if you had gone to your parents and they even told you that it's dead, you might have looked at them and internally say, I'm not going to pay you, mom and dad, or anyone that you know you're not going to pay. So there is a possibility that it was going to be what? There is a possibility that it was going to not be a liability because you got it from a loved one. So that's why the standard recognizes that it could be a liability or an equity to you who went and asked money. Because we were told in finance that a company, when it wants money, its sources of finance are what? Are equity and debt. Oh, so that's the link here. So we are now linking that thinking in finance with this. Because now if I'm going to ask for money, I have either going to ask for equity or debt. So that's why this standard is to establish the principle for someone who is asking for money. So we know whether the ask is what? It is equity or is it debt? So now we are starting to think in an integrated manner. And we are now understanding why the standard says from the issuer's perspective. But now it classifies the instrument into what? Into financial assets, into financial liabilities, and equity instrument. So do you see those three things I was talking about? So just say, in case you are not believing, this is how you now believe. Because the standard said so. We are going to classify this as financial assets, liabilities, and equity instruments. Do we see that? That's why we are here. But it's not done. Let's hear what it says. The classification of related interest, dividends, losses, and gains. So what are we saying? Are they saying that there is a relationship between how we classify interest, dividend, and losses and gains with the what? With the classification of the instrument? I didn't know, but now you know, because the standard says we are going to help you with it. So in other words, if you say something, it's a liability, it will then have an implication on the interest. If you say something, it's equity, we will likely going to see it in the statement of changes in equity. How do I know these things? Because IS 32 told me so. Okay, then I then say the principles in the standard, that's paragraph 3, complement the principles for recognizing and measuring financial assets and financial liabilities in IFRS 9, and for disclosing information in what? In IFRS 7. If I didn't know there was a link, IS 32 made me to know. It made me to know. are you excited? You know, maybe you had breakfast in front of you and now you are just saying this standard, this is what I want to have for breakfast. Are you there? Like, I want to have this. Are you seeing these things? You chose this career, you guys, but you love this. You loved it more than before me. But are you seeing this? That all these things, the answers are in this standard. So that's why mastering technical knowledge is so important.
All right,
So,
so can I ask something?
sure, please.
Why do we have those classifications, disclosures in different standards and not one standard?
Because it's so complex, and you're gonna see why. Remember, if you look at the financial statements of a bank, you will probably understand about 10 to 20% of the stuff. The other stuff are just complicated. And as I'm saying that they therefore needed to do it over phases. And this is the legacy issues. Because legacy said that we were trying to first deal with this problem, we develop a standard. Then this problem started to arise, we develop another standard. Then this problem arose, we develop another standard. So there were standards that were dealing with different things based on the need. Then over time, they then also asked the same question that you had to say, but why do we need them separately? Then someone said, let's start to bring them together. So when you say, you see IFRS, just like IFRS 15, where it was bringing IS 8, it was bringing IS 10, the construction contracts revenue standard. It was bringing IFRIC 13, I think. So there was a time where we didn't know what we didn't know. And we were trying to adapt to say, oh, now there's this, let's now give a standard. Oh, there's this, let's do this. There's this, so that's how. So it's like, we're people, we don't have all the answers and all the problems together. So as the problem emerge, they start putting a lot of things. So that's why they are there. But now they then said, should we bring them together? Then they're like, no. These things are so fundamental that they need to be dealt with separately. Because when you disconnect things, it then helps to create standards that are able to cater for a wider problem. So that's why we find ourselves here. So I promise they're not trying to make life difficult. I know sometimes we look at this and like, yo, guys, it's like they don't want us to be CAs. No. So they want you to be CAs and help in this regard. It's just some of these things are very, very complex in practice. Okay. So we are here. We are now saying we like what we are reading. Now let's quickly jump to paragraph 11. So now I'm in paragraph 11. What am I doing here? Because I said things need to be defined. If you are asking me to say whether this is a financial asset or a financial liability, then you have to tell me which one is which. Do you agree? How will I know I have a liability? How will I know I have a financial asset or an equity instrument? What is it? That's what we want to know. But now let's talk about the contract. Before we go anywhere, how did we know we were here? So let's understand, because we are saying the contract is a financial instrument, but how did I know it was not an intangible asset? How did I know? So let's read the definition of a financial instrument. It is any contract, so tick, because there was a contract, it ticked that. That's how we know that it could potentially be a financial instrument. Then it says that gives rise to a financial asset of one entity and a financial liability or an equity instrument of another. So this definition is very good. So let's understand it. It's you and the bank. So the standard says that this is a financial asset. So this is a financial instrument. If to one of the two parties, it is what? It is a financial asset, and to the other, it is either a liability or an equity instrument. And now we have defined who you are in the contract, and we've called you the what? We've called you the issuer. And the bank will now be the opposite, which is the holder of the instrument. So to you, it could be what? To you, it could be a financial liability or an equity instrument. So how did I know that it applies to me? As I was saying, it's a finance concept where we are saying whenever we talk about source of financing, we talk about debt or equity. So to you as the person who borrowed, it could be that you were borrowing equity or you were borrowing a liability, or you were getting equity or borrowing a liability. So that's how I know that the second party is talking to me. So we are linking it with financial management principle. So that means to a bank, it must be a financial asset, but we have to prove it. For it to be a financial instrument, it has to be a financial asset to the bank.
Sorry, Rendani.
Yes.
Sorry to stop you. I always get confused with the whole issuer and holder. In my head, I always thought the bank was the issuer because the bank is the one that's giving me the money. And I thought I was the holder because I'm the one with the car.
Yes.
So that's always, so every time the question would say, you know, issued,
yes.
My brain is opposite.
Yes.
Because my brain is saying you're the one who's holding the car, the bank is the one that's giving you the money. So in my mind, I'm thinking the bank is the issuer because the bank is giving me the 155 and I'm the holder because I'm the one keeping the car. So maybe if you could just break it down for me so that at least going forward, I will not struggle with that concept because my head just has it the opposite way.
Sure. So the first important thing that you need to do is to disconnect the application of the funds. So disconnect that. So because that's a separate transaction. The transaction at play here, it's the exchange of cash. Who is giving someone the cash? What we are going to do with the cash, we are saying don't connect it so that you don't confuse yourself. So the same way that you can just go and get an overdraft and decide whether you want to buy a car, make a deposit for a car, pay lobola and all these things, we are disconnecting the application of the funds. We are only looking at the exchange of the funds. And the question that we start with is, who is asking for money? Who is going to receive the money on day one? The one who receives the money on day one, we are saying is the issuer. So whether they receiving the money and instructing the money to be paid to a dealer, but it's their debt. So that is what an issuer is. The one who is initiating the asking of the money. Does that make sense? So that's how you need to think about it.
Perfect.
Who is asking the money? And that will always help you regardless of where you are, how complex the issue is. Always start by that question. Who is asking for the money or receiving the money on day one?
Perfect.
Sure.
Thank you so much.
All right, great.
I'm saying just to add on to that, because it also used to confuse me. I don't know if it will help or what, but if we could maybe put in mind what you just explained now about always knowing that there can only be a financial asset on the other side and an equity or a liability on the other side. Also try to look at who is the holder. Who is the holder of
Someone muted you or you got disconnected?
Sorry, sir, I'm still here. I wanted to say that also look at who is the holder, um of the instrument. Like for you to determine who's the holder, you look at who's holding the investment or who's holding the asset. So there can only be one party. So if that party is holding an asset or an investment, it automatically means that the other party is actually an issuer. I don't know if that makes sense.
Sure. Yeah, yes. So that's what this is saying, to say that there's a financial asset, which is the investment most of the time. Okay. So now we are saying, if you are asking me that there is someone with a financial asset, I need to know what is a financial asset and be able to tick it off to say, therefore, the bank has a financial asset. So let's quickly look at what? At the definition of a financial asset. So one, a financial asset is any asset that is cash, but the bank doesn't have cash in this contract. So we're talking about this contract. So the bank doesn't have cash, all right? The only thing that we know they have is a piece of contract with my promise to pay them money over the next 72 months. So that's not cash, it's just a promise. Then number two, the bank has an equity instrument in another entity. No, the bank, I've not given them shares in my company. So that is not B. Then number three, the bank has a contractual right. One, they've got a contract, and I know that they can even get a court order to take back the asset because they have a right to receive money from me. So it seems that the bank is ticking number three, that they've got a contractual right. But to do what? Then we look at I1. To receive cash from me being another entity. So it seems that the bank has ticked what? Paragraph C, to validate that it has a financial asset, because it's got a contractual right to receive cash from another entity. That is how we know we have a financial asset. It's either cash, it's either an equity instrument, or a right to receive cash. So when we see an accounts receivable, we will expect there to be an invoice. And that invoice, if you don't pay, I can take you to court and say, this is the invoice that validates that this party and I entered into a transaction and they are obliged to pay me. It is a contractual right to receive cash. Likewise, the bank now has a contractual right to receive my 4,500 rands installments. So tick. Now, we are going to skip all these things and we're going to talk about them from a financial liability. So now, what do I have? Remember, it now becomes tricky for me. It's tricky for me because I need to know. Remember, for me, it could go either way. I need to know whether I've got an equity instrument or I've got debt. And I want you to shy away from thinking about this from an example, but rather from first principle and going to the example. So what is a liability? A liability, a financial liability, it is any liability that is a contractual obligation to deliver cash. A contractual obligation to deliver cash to the bank. Do I have a contractual obligation to deliver cash to the bank? Let's think about this carefully. Do I have a contractual obligation to deliver cash? What if after signing, I burn that little piece of paper? What if after receiving it via email, the copy from the bank, I delete the email? Will I still be obliged to pay the installments due to the bank?
Yes.
Yes, there is a
Yeah.
contract that compels me to deliver cash. But let's just be clear here. What does it need to say to know that I've got an obligation? What does it need to say? So do you owe the people that raised you to get you this far? Do you owe them money and say, guys, thank you for raising me. You paid for my school fees, you paid for my meals, and so on. If someone comes that raised you and say, yeah, you owe me so much, will you agree that you have a financial liability towards them?
No. No.
What is missing? Because you received a cash benefit.
Because there was no contract concluded.
No, wasn't a contract. I didn't accept it. I didn't want to be here.
Black tax. Black tax is what? The oral agreement. So that means it will fail to meet the test, the contractual part. So they could probably go to IS 37 and say, yeah, there was a valid expectation that was raised. How do you think that I got you into this world and paid you for all these things? So one could argue that there was a contractual, there was probably a constructive obligation. But now the issue that I'm trying to deal with is that what makes a financial liability to be different from another liability is that it is created by a contract. A provision, you could just be sued and there's no contract, but you could end up with a contractual obligation. You could end up with an obligation to pay cash. Do you understand? So what makes this to be different from other liabilities is that it is triggered by a contract. So if there is an obligation that the entity has, but there's no contract, you jump to IS 37. So that's what makes this standard unique. Because people were asking that, why don't we just use the standard we have? Because it's called provisions, contingent liabilities, and contingent assets. And when I go to definitions, it defines a liability. So what makes this liability different? Now you know it arises from a contract. That is what makes this liability to be different. And that is therefore how we know we are in IS 32 extension IFRS 9, because there is what? There is now this contract. But now people then came and said, all right, what if I do sign this agreement? And it then has a clause that you will pay this amount when you qualify as a CA. So now that's interesting. So now I've got, okay, let's take a step back. That will be our last example. So now it is an obligation to do what? It is an obligation that arises from a contract to deliver cash. Tick. Now, what does the contract say? Because people started asking that these contracts are complicated. How so? What if I say that, and we have seen those, especially in Jan, buy your car now and only start paying from March. So now, do you have a contractual obligation when the payment can be delayed When you enter this contract, do you have a liability, a financial liability? What do you think? When you bought your car in December and the bank and the dealer was clear that buy your car now and only start paying your first installment in March, did you enter into a financial liability contract on that day? Yes or no?
Yes, you did.
How do you now, what was then the basis or the effect of the installment starting to be paid later to you? Does it have any effect in classifying the instrument?
No, I don't think so. I don't think it has an impact.
No, it
in
doesn't.
Yeah, maybe the impact will be on the measurement.
Sure,
Yeah,
100%. So the issue here is that the contract, one, still exists, and two, you still need to deliver what? Cash. And that brings us to an extension of this principle, that the obligation exists to the extent that they are fixed and determinable dates. So this is the kind of wording you use now in your discussion. Now the examiner will then have said the payments happen every year. But now you're saying that the obligation exists because it is paid on a fixed or determinable date. Does that make sense? As long as there is a fixed and determinable date, you have a contractual obligation to pay. All right, so that's number one. Number two, what if I say, yeah, I know it's a little bit rough now. You're still doing your training, so I'll give you the 150,000. You don't need to worry now. I'll call you when you need to worry. In other words, before I want my money, I'll give you a 30 days notice. And you know that I'm well off. And you're thinking that, nah, Rendani, it's not going to ask for this money. Do you have a financial liability in this arrangement?
no. Isn't it more of a provision now?
So let's just refine the terms. So the terms are saying on day one, Rendani will transfer 150,000 to Lutando's account. Done. The payment terms are such that you will pay 4,500, provided Rendani makes a request in writing demanding the payment to start. Rendani will have 30 days, will have to give a 30 days notice before the first installment is demanded from Lutando. That's the contract we have agreed on. Do you now have a contractual obligation to pay Lutando?
I don't think you do, because there's a contingency clause that exists.
Okay. So I'm saying that no, this contingency that Lutando and Rendani have entered into is saying that it doesn't give rise to a contractual obligation to pay. Anyone who wants to agree or counter that?
So this form of agreement, how did one agree with the person who's selling the car?
But remember that we don't care about the use of the money. We only care about the contract, the transaction of the exchange of the money.
I wanted to, that's the part I'm a little bit confused. Why? Because when you're talking about contracts, especially based on IS 32, it makes me go back to, I wanted to ask you, but now it comes to this point. How is it related to IS 32.13? Because when I look at it, they were talking about, they were bringing down in contract that contract does not have to be in a written form. But now when I'm looking at this, it's a little bit confusing, because how is you were talking about a contract has to be in a written form, and then now it confuses me with my IS 32 standard.
But wait, a contract does not need to be a written form.
So
the standard just says the contract needs to be established by the laws and the provisions applicable in a country. So there's no requirement for it to be written.
okay, so on this question, I wanted to ask us not to answer, but I want to find out with this one. Can you please repeat what you said? Because I was a little bit confused with the contract part. How did they come upon the agreement, or how was the discussion made between the two, please?
But that's irrelevant. I will not want you to focus on it because that's irrelevant. The how is irrelevant.
Okay.
What is relevant is what we agreed on. How, whether I sent you an email, whether we were sitting like this, whether it was formalized, whether this is customary, that's irrelevant. What we need to acknowledge is we have agreed on this. So how do we now account for it?
All right. Now I see it. I just wanted to find out that part. I was just a little bit lost. Thank you.
So to send this question earlier on, disconnect the use of the money, and again now disconnect the how. Deal with what has been agreed.
Okay.
Okay. So are we all going with Amkhelang's view that since there is this contingency, then we don't have what? We don't have what do you call this? We don't have a liability. Or does someone have a counter agreement or counter argument? Kumbero, please.
Hi, sir. I would like to try, but I didn't get you on the agreement part. If only you can just repeat on the agreement part, then I will try.
So the fundamental of the agreement is that there is a provision or a contingency that I will let you know when I want my money. That is the foundation. I will let you know when I want my money back. I will let you know.
So you are saying the discretion is on the issuer or the holder?
No. So don't complicate it. Just so let's talk about the substance and how you're understanding it. So I am the one who gave you the money, and I'm saying I'll let you know when I want it. Because the terms in a question will not tell you this, the holder or the. So if that is necessary to consider, then just tell us about it. Because I'm saying that there is a contract, tick, but the contract says Rendani is giving you 150, you'll be obliged to pay 4.5, but Rendani will tell you when he wants his money back. That's it. So in order to decide, I want you to tell me how you're going to go about it. So Amkhelang says there is a contingency, I'm in agreement, and she's therefore saying that, oh, since there's a contingency, then this is a what? This is not a liability. That's a view.
I think I agree with her.
You agree?
Yeah, because you explained that there must be a fixed or determinable date of payment of the contract for the contract to be valid. So in this instance, there isn't a determinable date, so it will be, you will have to wait until such time that Rendani decides when.
Good. So, and I love how you're answering, and I hope you are gonna promise me that you're gonna write like this in an exam, because you always in accounting have to start with a basis or provide a basis for why you're saying something. Whether we're gonna agree or not, there should be a basis. So I had said earlier on that the dates need to be fixed and determinable, but now in what we just signed here, it is not fixed or determinable. But now the standard introduced another test. The test then says, can the person who borrowed the money and is required to pay, can they choose to avoid making the payment? So that's test number 2. So they call it the what? That term is not coming to mind. But now the key thing is when so it is saying that what can the person who borrowed the money and is required to pay back, they call it the cash avoidance test. Yes, the cash avoidance test. Cash avoidance test. So let's remember that. Let me just type it. The cash avoidance test. So the cash avoidance test says this. It says if I am required to pay the money, can I avoid paying it? So one, we have now seen that if cash is required on a particular date, then I cannot avoid to pay it. But now the contract I've signed says that you, as the person who gave me the money, you will tell me when you want your money. So if you will tell me, then tell me, can I avoid paying you when you've written me that notice that you now want your money from next month? Do I have the contractual right to avoid paying you?
No, you don't.
Then it's a liability. That's the thinking. Do you understand that logic? The cash avoidance test. Can I avoid paying if the contract is exercised against me? Because that person, the moment they type the email and say send and say, Rendani, today is the 9th of March. As per our contract, I need to give you a 30 days notice before I demand my money. So from the 9th of April, could you start paying those 4,500 installments? I cannot throw a fit and say, no, because the contract said so. It said you can come and ask for your money. So because of that, the cash avoidance test is met. And I cannot avoid paying you because I'm now compelled by the agreement. Whether you come 100 years later, as Lutando said before, that now affects the measurement. Because we need to now do what is the likelihood that the person will come in a year's time, likelihood that they'll come in year, second year, likelihood that they'll come in third year, and we start doing the measurement, attaching probabilities, but the liability exists. So if you have a friend who said, no, don't worry about it, I'll let you know if you need it, know that you owe them. There's no, I know, but he said, no. You owe that person. You need to always be thinking about their money. And that's why people say, I don't want favors. It's like there is some kind of there is some kind of an implied financial liability. But do we get that? The cash avoidance test.
But just to make sure that I understand, so are we saying that there is no contingency because of it's just the passage of time? The money will still be paid by
No, you were right about there being a contingency, but it's just the person who can exercise that contingency is not you.
Okay, makes sense.
Yes, so it's not you. So now we can now move to the third scenario, where now you then said that I'll pay you if my things start to pick up. So you are now the one deciding when you will pay me. So there's a contingency, but you are the one deciding when you will pay me. So that now is different, because when it comes to the cash avoidance test, you can control the avoidance of the cash payment. Does that make sense?
Yes, it's perfect. So which means the holder, if the holder has the contingency, then there is a liability. But then if it's the issuer that has the contingency, then there's no liability.
Yes, and we know this very well, right? Because if you think about what we've always learned in finance, we said what? Dividends, we love them because of what? A company will need to consider raising equity because dividends are what? They are not compelled to pay them. That's what makes dividends equity. Do you see that? That's what makes dividends equity, because you decide, you being the board, whether to pay them or not. There is no contract that forces you to do what? To pay those dividends. Does that make sense?
Yes, it does.
So 3 things, right? So 1, if it's payable on a fixed or determinable date, what do we have? We have a liability. If it is payable, but at the discretion of the person who gave you the money, being the holder, then there is a liability. If it is payable at your own discretion, then what do we have? We don't have a liability. We rather have an equity instrument. Do we see all that? Are we clear? Any question on that? All good. Great. So now, let's take it a step up. Then when we read further, we then see that actually the liability is a part B, which says it is a contract. So contract is always the foundation that will or may be settled in the entity's own equity instruments. So now I'm sitting here and I'm saying that, what do I have? What do I have? I have a contract. But now when I spoke to the bank, I said, bank, I see that you want this 4.5. I don't have the 4.5. Can we agree on the following? I'm going to start this company. It's going to be a super company, I promise. So now what I want us to agree is that I will not pay you in cash, but I'll give you shares in my company. Let's say the bank, they then said, okay, send the business proposal. I send, they review it. Oh, this is a brilliant idea. I'm happy that this agreement now, you don't pay in cash, but you pay in what? In shares. So we are still signing an agreement, but it will not be paid in cash, but rather I'll give the bank shares in my company. We are clear with the facts, right? Now, how do we then classify that instrument? So then we need to establish whether the shares that we are going to give, are they variable or are they non-variable? So the bank will then come and say, how many shares will you give me in the future? Then I could say that, okay, since you're giving me 150 now, I expect my share to be 200 rands each in future. So to pay off this liability plus some interest, so let me say that I then do it. I then say it's 150, and then I say I'm going to give you a 20% premium. So I'll be paying you the bank what? I'll then be paying you the bank 180, and the share price I expect it to be 200,000. So I'm going to give you what? I'm going to give you 900 shares in my company. So we agree on the number of shares today. So the number of shares I'm promising to the bank are what? Are fixed. Do you see that? The number of shares that I'm promising to the bank they are fixed at 900. So essentially, I will be said to say, I'll be said to have a fixed number of shares that will be required to settle this contract, and that will give rise to an equity instrument. Then maybe in scenario number 2, the bank says that, okay, you owe me what? You owe me 150 and I want a premium of 30%. You and I, we don't know what will be the share price in future. And I don't want to accept that your share price might be 200 because there's a risk that it could be lower. So now what we need to agree is that you will pay me enough number of shares to settle my liability. So if your share price is 100 Rand, it means you will give me what? 1950 shares. If your share price is 50 Rand, you will give me how many shares? 3.9. If your share price is 200, you will give me how many shares? You will give me, so on number of shares, 975. Do you see here that the bank does not want to take a risk on a particular share price? They're just saying that give me as many shares that will be sufficient to extinguish the debt that you have with me. So here, this agreement gives rise to a variable number of shares, and therefore it is a financial liability. Does that make sense? Do we understand these two scenarios here? So what is the principle? The principle is that if there is variability in the number of shares given, then what do we have? A financial liability. If the number of shares is fixed, what do we have? We have a fixed, we have an equity instrument. So that is what we have. All good. So we now know how to get to an equity instrument, and we know how to get to a what? We know how to get to a financial liability. So now let me just give you a quick example to just hear from your side. So company A issued options to its employees. In the terms provided that the employees can buy 1,000 shares in company A before 31 December 2024 at 20% to the what? To the prevailing market price as listed on what? As listed on JSE. So that is scenario number 1. Scenario B. Then this before 31 at an exercise price of 20 Rand per share. So now tell me, which of these will be a financial liability and which of these will be an equity instrument? Who wants to give it a shot? Who wants to give it a shot?
So for A, we
Yes.
have an equity instrument.
Okay.
No,
Mhm.
no, for A we have a liability instrument, and for B we have an equity instrument. The reason being is for A, since they say that we can buy it at 20% of the prevailing market price. So there's no, it's not constant, it varies. It will depend on the day, what is the 20% of the prevailing market price. And then whilst for B, they gave us a specific amount, which is being raised. So it's not variable.
Sorry, I'm realizing I don't want to create. Let me remove this. All right, yeah. Let me remove that part. It just complicates life. But essentially, that's correct, right? So there is what? Variability in the number of shares that the employees can buy. Therefore, financial liability. Then what do we have here? Here we have fixed number of shares at a fixed price, therefore equity instrument. Then let me do C as well. So company A issued 1,000 debentures that are convertible into ordinary shares, right? Then the conversion will take place in 5 years' time, in 5 years. And each debenture will convert at a what? At a price of 50 Rand per share. So issued 100 debentures that are convertible into ordinary shares. Then scenario C, the conversion will take, and each debenture will convert at what? At the prevailing market prices. So now we've got this. So we've got scenario C and D. So A, what we are saying, scenario C, we are saying you have 1,000 debentures that you bought from me. So you paid 100,000 because each was worth 100,000. Then I told you that I'm not going to pay you in cash, but your instrument, you bring it back in 5 years, and I'll then give you shares in my company, and the price that will essentially be buying those shares will be at 50 Rand per share. Then for scenario D, same, but what I'm saying is that when you bring it back in 5 years, I will then look at what my share price is. Then I'll then do what? I'll then pay you so that I extinguish this liability that I've got. So what do I have for C and D? Do I have a financial liability or an equity instrument?
I'm gonna give it a try.
Yes.
I would think that for C, it's going to be an equity instrument because the share price is going to be the 50 Rand, which is not moving up and down. Sorry for lack of a better word. And then for D, I would think it's going to be a financial liability and an equity instrument where the prevailing market rate will be the liability portion, and then the conversion will be the equity portion.
Okay, so here, equity instrument, because the number of shares are determinable on what? On contract inception. Because what?
They're fixed.
Yeah, the price is fixed and therefore issued number of shares fixed. Okay. Then for the second one, we are saying that you are saying it's compound. This is
It's
both.
compound. Yes, it's compound.
And you just walk me through that one again. You are saying why so?
I'm saying because they will convert the shares in future to ordinary shares.
Yeah.
However, the ordinary shares, when they convert them, those will be equity. But however, there's a portion of the prevailing market that they'll need to pay, which will be variable as per what the share price is at the time.
Okay,
So
maybe let's just clarify the mechanism, right?
Okay.
So you will come to the company and say, do you remember that I bought these shares from you, these debentures from you? And I bought 1,000 of them. So essentially, I paid what? I paid 100,000. Yes. So now you, as the company, told me that after 5 years, I can convert them to ordinary shares, right? So here is that piece of paper that is worth 100,000. Then they will say, all right, let's go to the JSE and check what is the share price. Then they can say, maybe you are waiting for something on day one, on after 5 years. Then we are agreeing that the share price could be 20 Rand, possibly. Then you will then be given shares. That's what? Equivalent to 5,000. So now you have ordinary shares, 5,000 ordinary shares instead of 1,000 debentures.
Correct.
So now I just want to understand. So if you go through that again, so what are you saying? How are you getting to the compound?
I think I'm confusing myself in the class.
Okay. So are you
I'm
clear
only
now?
seeing just, yes, I'm only seeing just the financial liability portion. I think for me, at the back of my mind, it's always that you will think that whose option, is it the option of the holder or is it the option of the issuer?
And we're going to talk about it next.
Yes, that's where I think my mind was. So sorry, guys, for confusing you.
No worries. Thank you. So here, maybe let me also just clarify that this will definitely, the conversion will happen. So in other words, the conversion will happen. It's not that someone will decide. It is how the instrument is. I'm telling you, I'm not going to pay you. You will just convert. So it's not like I'll decide or you will decide. That's how you're going to get your money back. So if you then want to get cash, you will first convert and then sell your shares. So the other one you might be thinking about, we're going to deal with it just a little bit later. But now I just want us to agree. Does everyone agree that there's variability in the number of instruments that can be issued? And therefore, this is a financial liability. Everybody aligned? Okay, I see a chat. May someone please explain why, when this variability gives rise to FL, missed that part? Oh, it's just the standard. So that's just the standard. We got it from paragraph 11, the definition of a liability. So that's just the standard definition. All right, all good. Is it making sense? Do you see that this thing, it is complicated, but it can be digested. You just need to deal with it parts by parts. Okay, great. So let's take a short break. Then what we're gonna do, we're gonna just expand on what Sandy was saying about that sometimes there is an option. Sometimes there is an option, and therefore, when I analyze the instrument, I need to take into account that option. And we're gonna see what is the impact that it has on what we already know. So 10 minutes break. Let's be back at 10 past 10, please.
Thank you.
Thank you.
I'm just going to type it so that we are aligned. Sure.